If you're a business owner, you pay taxes when your business makes a profit, even if you don't pay yourself a dime. So in today's video, I'm going to show you the 3 best ways for how to pay yourself in the most tax efficient way possible so that you can save tens of thousands of dollars on your tax. Now, there's a million different ways to do this, but I'm going to show you the 3 best ways. So what are they? The simplest trick that anybody could do is what's called an owner's draw. Number 2, a little bit more advanced hack is being what's called taxed as an S corporation. And number 3, finally, a more complicated technique that CPAs use to lower your taxes is what's called taking a reasonable salary. Now, my team and I use these 3 techniques every single day to save a minimum of $10,000 every year for our tax planning clients. We've already used these frameworks with over 200 businesses to date. And by the way, if you want us to make sure that you pay the lowest possible taxes and pay yourself in the most efficient way, click the link below to apply to work with us. Now, let's start with the simplest technique. The first way that you're going to pay yourself is what's called an owner's draw. Now, honestly, this works very simply and it's almost too easy. When your business is first making money, you're making a profit, you feel good. You feel like you want to make it rain, and eventually you want to pay yourself. Totally reasonable. Now, we want to make sure that we do this the right way. When you first want to start paying yourself from your profitable business, you're simply going to log into your business bank account, and then you're going to transfer the money from the business account to your personal account. Let's say $5,000. And that's it. That's all you have to do. The best way to do this is what I would say is get on a schedule. You want to be paying yourself regularly. I would say preferably the 15th and the 30th of each month. This helps give you clarity, and it's super easy to see exactly what you've been paid and how often you've been paid once you're on a schedule. Now, this works for most small businesses, sole proprietorships, LLCs, partnerships, S corps, and even C corps. Easy to do, but also easy to mess up. Most people do this the wrong way. They pay their personal bills directly from the business bank account. They pay their rent, their groceries, and their business expenses all from one bank account. And quite honestly, that's not the best way to do it. But you might ask yourself, why does any of this matter? If I'm making money, what's the big deal? Well, there's actually 2 things. Number 1, you're going to be unorganized. Now, what do I mean by that? If you are spending different amounts on groceries, rent, it makes it really hard to actually see what you pay yourself because the amounts are going to be different. It's very infrequent. It's actually kind of hard to see what you took out of the business. It's very hard to see that. The second thing that can happen when you start treating your business like that or spending personally out of the business account is you can have veil piercing or piercing the corporate veil. We've all heard that term, but we don't exactly know what it means. This is an easy explanation of what that is. Let's go back to the beginning. When you form an LLC, it's basically what the name stands for, limited liability company or corporation. They're formed for legal separation between you and the business, hence the name. However, what happens is if you start treating your business like an ATM and you pay for everything out of the business account, business and personal, a court or even the IRS can say, you don't treat your business or you don't treat this like a business. You're treating this like an ATM machine, and your protection or separation can disappear. And we don't want that. And the cleanest way to avoid all of this mess is simply just pay yourself first, transfer the money to your personal bank account, and then spend it personally. That's it. That's a simple way, simple, legal, not tax optimal, but it's clean and legal. Now, the second way to pay yourself is what's called being taxed as an S corporation. Now, this is only when you're making a consistent profit. Think at least $80,000 a year. Now, the reason why this is important is that this is where taxes actually start to change and you can start pulling certain levers, because this method involves paying yourself a salary. But to understand why it saves you money, we really have to know one easy concept. We got to know, how do business taxes work in the US? Most business owners in the US, your LLC is what's called a pass-through entity, or maybe disregarded entity, but we're going to use the term pass-through entity. It is a fancy way of saying business owners or businesses don't pay taxes. The owners of the business pays taxes. Now, let's look at an easy example. Let's say that I own a business and my profit in the business is $100,000. Now, based on that, and in the introduction of this video, the owner pays taxes on that $100,000 as a pass-through entity, regardless of them taking the money out of the business or leaving it in the business. And every single business or business owner, you have three taxes when you file your taxes. You have your federal tax, you have your state tax, and your self-employment tax. Your self-employment tax might be more commonly referred to as FICA taxes, Social Security, and Medicare. It's a sneaky one. Now we want to focus on this self-employment tax because federal and state, it's a little bit harder to eliminate or really get rid of. Let's go back to that $100,000 in profit. Before being an S Corp, you have to pay 15.3%. And this is just a rough example. That would mean that you pay $15,300 in self-employment taxes. That's a lot of money. But let's assume that you decide to be taxed as what's called an S corporation. When you do this, you have to pay yourself a salary, a W-2 salary, because you are an employee of your business now. Now, let's go back to that same $100,000 profit example. The IRS says that you have to take a salary. So let's say we decide to pay ourselves $30,000 out of that 100. So now my profit is 70. When you pay yourself a salary of $30,000, you have to pay, that's still 15.3%, which is roughly $4,600 on W-2 wages. No getting out of that. However, the remaining $70,000, you pay that 0% in self-employment tax. You're basically telling the IRS, I don't want to pay all of my profits in self-employment, only some of it. And now you have gone to saving almost $10,000 in self-employment tax just by making that one move and changing the way that you pay yourself. Now, to be clear, this applies to S Corps. C Corps a little bit, but we're only going to focus on S Corps. If you are just an LLC without an S Corp election or a partnership, you are still subject to that self-employment tax. Now, we want to make sure that we are paying ourselves the right way. There's a right way to do things and a wrong way to do things. The right way is you want to pay yourself two ways when you're doing this: a W-2 salary and what's called an owner's draw. You want to be doing this regularly, preferably like before, the 15th and the 30th of each month. Now, where this becomes a little bit more complex is that you could potentially pay yourself twice each pay period: a W-2 check with your taxes withheld and an owner's draw. You're transferring from the business bank account to your personal bank account. That's the right way to do it. Now, I recommend having a payroll company administer your payroll, such as ADP or Gusto, because this is very easy to do, but it's also easy to mess up. Gusto and ADP, they do it for you, and they also take the fall. If they do it wrong, they will reimburse you and deal with the IRS. If you do it wrong, you have to deal with the IRS. I'd rather have Gusto and ADP do it, and that's what we have all of our clients do. Now, there is a wrong way to do this. The wrong way to do it would be trying to run one big payroll at the end of the year. You might hear other influencers doing it, and they do this instead of taking a regular payroll. That is like trying to cram the night before a test. It doesn't work. You will always mess it up. Do it regularly. Do not try to cram the night of a test because you'll end up failing just like we all did in school. Now, the third method that we want to talk about, this is a little bit more complex, is what's called taking a reasonable salary. Now, I want to emphasize this enough. DDIY. Do not do a reasonable salary yourself. Have a professional do it, somebody like us. Now, we do this for all of our tax planning clients. Again, if you want us to do this, click the link in the video, apply to work with us, and just have us do all this stuff for you. Trust me, it's a lot easier. Now, when you are an S Corp, we want to go back to that. You're supposed to pay yourself a W-2 salary, or what I like to call it, or the IRS says, is a reasonable salary. You want to think, what would you pay a stranger to do your job? We do not want to just randomly assign a salary number like, oh, $30,000. That ain't going to work. It has to be reasonable. It has to be, quote, what's reasonable. Now, Again, we want to be doing this the right way because you might be wondering, well, what's a reasonable? I don't even know how to do this. This would be the right way to do this. Now, this is how this actually works. This is a company that we use. It's called RC Reports Reasonable Compensation Simplified. Now, again, this is a company we use. You don't have to use this one, but it's more the idea. You want to do what's called a reasonable comp study. What it's going to do, it's going to ask you some questions about your job duties. You know, you answer some questions, and it's basically going to tell you in your market, what would you pay somebody to do your job? Now, let's use me as an example. Now, again, there's plenty of those as the one we use, RC Reports. Now, let's look at me. Let's say that the study tells me a CPA in Des Moines, Iowa, where I live, is $50,000. Now, back to that example, I would pay 15.3% on $50,000, which is roughly $7,600, $7,700 if we want to be exact. Now, you could pay that self-employment tax on the $50,000. But let's go back to one thing. We are an employee of our business, right? I'm an employee of my business. If you're an S Corp owner and you work in it, you're an employee and an owner. What do employees get? They get benefits. Think health insurance, HSAs, dependent care, retirement. Think benefits, right? That 50,000, that's a part of it. So if you're already paying things for your health insurance, your HSA, your IRA, retirement, that's part of your compensation. It doesn't have to be all 50,000, right? It can include those benefits. And one thing that I like is that certain benefits are not subject to the self-employment tax, right? Let's assume that I have $10,000 in benefits between my health insurance, my HSA, my retirement, right? So instead of paying myself $50,000, right? If I'm already paying $10,000 in that, I can chop that off of my self-employment tax. And now I'm only paying self-employment taxes based on 40. I've just saved another $1,530 in taxes by just doing a reasonable study report instead of just randomly, there it is, right? There's a little bit of randomness to it, but we want to be doing things with a measured arrow. And these are normal employee benefits, but when you structure them correctly, it really can reduce how much payroll taxes you're doing. Now, I'm not going to walk through every single example and show it, but it's more just the idea. And again, we're really just changing how the money gets to you legally before it ever hits the self-employment tax. And this is where 5 figures in savings can start. Now, again, let's say you have a lot of health insurance, it's even more. This is where the 5 figures in savings happens when you know what you're doing, when you're working with somebody. Right now, that's the right way to do it. Now, I'm going to tell you the wrong way to do it is to try and DIY this yourself. That is literally it. If you try to run your own RC report and try to report your health insurance on your W-2, you're going to mess this up. I'm without a shadow. A lot of accountants mess this up. You have to take this very slow. I would not AI this. I would not chat GPT this. That's literally the only wrong way that you can do it is by trying to do this yourself. And if you do it incorrectly or try to do it yourself, this creates problems, right? Not automatically, but if the IRS ever asks questions and you can't really detail like how you did this, then it's not really worth the squeeze. And again, as a business owner, we want to talk about working smarter, not harder. Now, again, for all of our tax planning clients, we do this for them. We take care of their reasonable comp study, setting up their payroll, making sure their benefits are calculated correctly. We do all of this for them. So again, if you want to work with us and have us just do this for you, click the link in the description of this video to work with us. We'll do all of this for you. Again, my name is JT, one of the owners here at PNT Advisors. And again, look forward to working with you. Take this off your hands. Do not do this yourself.